We are now in session 3, financial markets, distress and household finance. One sector of the economy is the consumer, is the household, and financial markets impact them a lot, leverage impact them a lot. We're going to talk a little bit about those issues. To discuss that, we have Professor Chan Wen Lan, Dean's Chair and Associate Professor in Finance. And then Johan Sulaiman, Dean's Chair as well, and Associate Professor in Finance, and Academic Director of the NUS MSc Finance Program. We also have Ben Charan Wong, Assistant Professor in Finance, Chang Wei Na, Senior Lecturer in Finance, and last but not least, we have the ubiquitous Professor Sumit Agarwal, Lau Tak Kwang Distinguished Professor in Finance and Head of Finance, who has been with us throughout, loyally and dedicatedly at every session. And part of the reason is because he proposed this idea initially. So with that, can I ask, this session will discuss about two things: the uneven allocation of the burden across the consumer segment, the household segment, from the lower income all the way to the high income people, and also small businesses. And how does this, and secondly, how does this economic fallout and financial market meltdown impact the ordinary investor from their investment strategy, from their spending policy, retirement policy, and those issues? What are the tools in place that the government and corporates can use, or individuals, advice for individuals in this very trying circumstance during this virus pandemic? I will start by asking Wen Lan, Professor Chan Wen Lan, to perhaps talk. I mean, 80% of Singaporeans, and this is Asia Bureau held in Singapore, I'd like to focus on Singapore. 80% to 90% of households own their own homes. A lot of them have mortgages and stuff like that. So can we ask Wen Lan to start to cover more on the real estate part and how that's impacting lives in Singapore? Any ideas or suggestions or improvements in the tools that the government and others can use? Wen Lan, could you start, please, with your opening remarks?
Yes, thank you very much. It's great to be with this great entire dialogue, and I've learned a lot from the previous sessions. So I would like to focus on my remarks from the perspective of the households, especially on the housing sector or housing portfolio, which is, as you pointed out, perhaps the largest financial asset in their household portfolio, and by drawing much on Singapore and also the Asian experience or the policy response and so on and so forth. So the way I look about the housing is from two sides. One is as a liability, as you have to service the mortgage debt. For example, in Singapore, 90% of the people own their home. So it's actually a significant part of the debt in their entire, on their entire balance sheet. And the mortgage burden is actually non-trivial. So the regulation says that in Singapore, actually, not more than 30% of your gross income can be used, or you cannot borrow the mortgage that exceeds 30% of your gross income. So that's the mortgage debt income service ratio, which puts kind of an upper limit. However, if you think about the current situation whereby we're hearing or we're worried about people losing their jobs, it's not about income, sort of a temporary income reduction. It's potentially a permanent unemployment. Then it's going to put an imminent threat to their ability to service their mortgage debt. Now, in the long term, if more and more people cannot serve their mortgage debt, it's going to create a rippling effect to the asset side of the market, which is the housing market. Now, looking at the housing side of the asset side, we've already seen some of the effect. So in the first quarter of this year, Singapore's private housing market has already experienced over 1% drop in prices, which is probably the first negative growth since the last year or so, where last year we've seen the housing market going through some recovery since the cooling measures, but we have already seen some of the effect coming down. Now, part of that is potentially because we have fewer foreign buyers, for example, from China, Indonesia, where everyone is scrambling through this crisis. And part of that is also people may already be losing their jobs or may fear they're losing their jobs, so the demand is going to retreat. So adding them together, it's going to create a challenge to manage the housing market from the household's perspective. One is to worry about service their mortgage debt. And second is about the potential to see their housing value to go down. Now, as a government response, I think the Singapore government is really being responsive and resilient, and they've seen this problem. So I think the two major measures which are going to be effective in the short term, at least in the short to moderate term, is the fiscal package and also what has been recently proposed by MAS. So the fiscal package, as a lot of people have mentioned, have been trying to help not only the consumers but also the businesses to ease the households, to smooth out the potential income shocks, and also to help the business to manage the potential unemployment consequence. So that at least in the short term or in the short to moderate term can alleviate some of those impacts. And particularly the government is actually very aware of the most affected sectors, retail, tourism, aviation, and also including the self-employed sector, and then provide additional support to those most affected sectors. That will be helpful. Now, the MAS also implemented measures to provide additional ways to alleviate the stress by allowing households or the mortgage borrowers to have the option to defer the payment on either their principal or the principal and interest until, I think, for about 9 months, until the end of this year. So this will put another alleviating measure that will actually ease some of the concerns or the stress faced by households. Lastly, what I want to point out is that in the long term, it's actually more uncertain, because even if you are able to kind of stabilize the economic situation, the job situation in Singapore or around the world, in the long term, I'm really worried about to what extent the management of the public health crisis will affect demand on its own. So what I mean by that is that we don't know a lot about the crisis or the public health crisis. We are still scrambling to learn on a daily basis on what this virus is, how does it transmit, how is it going to affect the morbidity and mortality, and what are the effective ways to control this. Now, when you have this large amount of uncertainty, people will be scared. So when people are scared, the fear, uncertainty, and anxiety would prevent them from going out and invest and purchase. We've already seen that happening in China. So China has gone through this in the early episode. You've seen that actually people are cutting down their consumption now, even with the crisis situation seems to kind of flattening to some extent. You've seen that people are still holding back their consumption need. Okay, they're still concerned about the potential risk out there. Now, when you have this, it's going to hurt the demand. Now, going back to the housing market, it's the same. So I'm worried about the potential reduced demand for the housing market assets in the future as well. So which will also create another downward force to the asset market, which will itself reinforce in many ways to the economy. For this, I don't have a good idea of what is the best way to respond. My overall sense is that it really depends on our management of the public health crisis, which will be a big uncertainty going forward. And I think the government, I trust the Singapore government, and I hope all the other governments are going to be sort of being very vigilant and agile and resilient to respond in a timely manner.
Thank you, Wen Lan. Thank you. I guess you raised 2 points, main important points. One is the first order effect, and the government seems to have taken care of that, at least in Singapore and some other countries. That is to give this sort of deferment in mortgage payments to alleviate the immediate liability that households face. But there are second order effects that fear, anxiety, and other factors may not induce spending, and that could have an effect on housing markets and other segments of the economy.
Yeah, housing market is only one aspect. Yes.
One aspect. Thank you very much for bringing up those points. Can I move to Ben next? Ben Charan Wong. because financial markets are a big part of this whole equation. We've seen people's portfolios getting hammered, both their wealth accounts, their retirement accounts. We've also seen illiquidity spirals from the GFC affecting markets tremendously, causing almost panic. I think some of the previous panelists talked about, in the earlier panels, talked about deleveraging effect at the corporate level. We're definitely going to see some amount of deleveraging on the household segment as well. Where do you think this is going? Should we be panicking? What kind of tools and policies are missing that we should incorporate? Could you share a bit of that insight? Perhaps comparing it to the GFC period, Ben.
Sure. Thank you very much for the opportunity to share some of my thoughts and notes. I think the first thing to do is to try to put this in perspective. The global financial markets lost about 22% year to date. Volatility term structure is inverted, and that's actually pricing a daily standard deviation of 5 percentage points over the next 30 days. So that goes to measure how much uncertainty there is in the market. If we're looking at dividend futures, it actually is pricing in a lower bound of a 40% decrease in dividends over the next 2 years in the United States and minus 50% over the next 2 years in Europe. So reading these indicators from the financial market, it certainly seems like the recovery will take a while, and that we're not out of the woods yet in terms of even making the turn to try to decrease the impact of the virus. There have been some coverage of what asset managers are doing. The reason we look to asset managers and some of the actions in the financial markets is because movements there can be very fast, and it becomes informative for us as academics and for policymakers to actually look at what happened, what's going to happen, and does this seem to be a crisis or not. So to put things in perspective, in 2008, the most famous hedge fund ever, Renaissance Technologies, returned 98% during that year. So far this year, they're making a loss. So for those who are huge fans of hedge funds, that should be an indicator that something weird might be happening. I mean, we certainly are in a liquidity crunch. We see demand for liquidity increasing from asset managers. Many of them are shrinking their positions. The implication for asset managers suddenly behaving in a correlated manner is that suddenly correlations across international markets, across asset classes, across commodities are all increasing. In fact, even cryptocurrency, which was touted as the digital gold not so long ago, also tanked during the same time with high levels of correlation. Now, what makes this slightly different is now we have a direct demand for liquidity from the corporate sector as well. So as of March 25th, companies in the US already tried to pull in or call their credit lines up to the tune of $124 billion. And consequently, this correlated demand on liquidity is forcing banks to restrict credit supply as suddenly they're getting drawdowns on their obligations. And so we see credit spreads spiking. So what does that all mean for households and people in general? Well, it's all fine and dandy for hedge funds. During this whole crisis episode, we still see Berkshire Hathaway issuing €1 billion in bonds at 0% interest over the next 5 years. A couple of days, just last week, they filed a filing with the SEC to issue more bonds. Now, the concern that we have with the stock market crash is we know people learn from their own individual experiences. This saying was cited before in the previous panels as well. Consequently, what we have learned from the global financial crisis was that millennials, that's people aged 23 to 38, so I'll throw myself in that category, 71% of millennials are saving, so that's a higher savings rate than the baby boomers. But on the other hand, only 49% of millennials are invested in the stock market. And this is based on a survey from 2018. So the implication for household consumption is I think kind of dire as Wenlan brought out. But with regards to where the equity markets and other financial markets are, I still think there seems to be some slack in the economy in terms of savings that could be deployed. Now, granted, it's not going to fully replace the full level of liquidity out there. But I think in terms of thinking about household portfolio policy from a regulation standpoint, I would think hard about how do we help to assuage some of the fear and uncertainty so that people are more willing to participate in the financial markets. The lesson that we're afraid people will learn, and what we don't want them to learn because it seems like it's the wrong lesson, is to avoid the financial markets completely. So I think from the policymaking standpoint, this is our chance to get more people into the stock market. In fact, equity risk premium have increased fairly dramatically in a very short period of time. Now, it's an endogenous thing to the economy. The fact that equity risk premium increases probably because other people can't take that risk. But that's where we start to look to maybe a new source of savings that could be used to plug some of this, some of the losses. One of my big concerns, this is the last point, is with respect to financial regulation. What we have seen after this market crash was actually more protectionism. So what we see is regulators in Europe, in France, Italy, Spain, Belgium, Greece, and even in China have already announced that they're trying to ban foreign companies from investing or taking over their companies. So now that tends to deter financial integration. And my concern with this trend is it's somewhat hard to undo. We think the financial markets is somewhat self-correcting. When prices drop enough, expected returns rise enough, someone's going to step in to enter the market. But if you're stopping them from stepping in and you're stopping financial markets from functioning, my concern with that is it might have some implication in terms of the unity at a global level. And we knew that financial markets were fairly integrated already, and my concern is that this will be a step backwards.
Okay, thank you, Ben. Financial markets are important. Participation is important. Instruments that are designed, innovations that are designed are also very important to deal with such crises. But one thing I worry about, we can discuss this later, is the divide. Every time events like this happen, the divide gets larger and larger between the rich and the poor, between small companies and big companies. So that's something maybe we can leave for discussion later. And how we can overcome or circumvent that. But talking about that aspect of finding new ways to help individuals and households deal with these kinds of issues that sometimes institutions can deal with. Because I remember reading that, Wena, you were cited or you wrote an article about how institutions can participate in pandemic bonds, which is a way in which countries get paid a premium if a pandemic hits. I'm just wondering if we could reverse that and find a way in which households who are struggling could also participate in some kind of format that gives them a payment when something like a pandemic or some kind of a big event happens. But in any case, my point is, are there new ways in which we can think about, more creative ways we can think about for households to participate in the financial markets in a meaningful way, in a small way, and yet protect their spending and needs, needs on a daily basis? Is there something you could add? Maybe share a bit of your experience on the pandemic bond side and other stuff.
Thank you, Joe, for the nice introduction. Okay, so in my couple of minutes of sharing, I will focus on three aspects. First, I will give a little bit of background how this pandemic bond is come about. And secondly, to talk about what is the current situation with the pandemic bonds outlook. And lastly, I would like to share three insights that I personally draw from the design and how would the household be able to learn something from the financial innovation that has been put forward by the financial markets. So I will start with the pandemic bond itself. This was a very innovative way for the World Bank's IBRD to issue the pandemic bonds in 2017. And the nature of the protection is basically for covering 6 different epidemic illnesses that can cause a significant financial stress for developing countries. So the World Bank has basically put the cap of $420 million to support for this kind of outbreaks. It is in the form of 3 different tranches of bonds, and also in terms of the swaps. Okay, so that the two tranches of the bonds are having very high risk in terms of the interest payment that the investor can receive. Basically, they are priced at the 6 months LIBOR plus 11.1% for the risky tranche, and the other less risky one is priced at the 6 months LIBOR plus 6.5%. So simply by looking at these numbers, you will know that this is a high yield, very high risk instruments to be invested in. And fortunately, coronavirus is under the protection of this particular pandemic bonds. So how did this bond work in reality? Well, as similar to catastrophe bonds, which is the precedent of the pandemic bonds, the investors will face the risk of losing their investment in terms of the principal amount when the pandemic hits. Okay, so it is have to be measured in terms of number of deaths and the number of countries that are being affected. Okay, so this would lead to the bond investor facing the capital losses if the pandemic is actually confirmed, and then the World Bank will distribute the funds to the affected countries. So this is what the pandemic bonds are about and how it is supposed to work. But my main focus today is going to focus on the three contention issues that has been brought forth by the pandemic bonds. The first question is that who should be the suitable investors for such a high yield debt instruments? Okay, so far this bond, when they issued initially in 2017, they attracted a lot of interest from institutional investors. So the bonds was oversubscribed by 200%. So who are these institutional investors? They are sophisticated ones, such as asset managers, hedge funds, and even the pension funds in US and Europe. And why they only attracted such sophisticated investors? Because the bonds are privately placed. They are not open to the retail investor to access. Why is that so? Because the very nature of this bond is so complicated. It contains 386 pages of description about how the epidemic is measured, how the spread speed will be calculated, and a lot of terminology are mixed with the medical jargons. So it is really hard for the retail investor to even start participating. Okay, so this is the first question, is whether the retail investor are suitable for this kind of sophisticated financial products that are going to take on the risk in the financial markets. The second issue that I find about this pandemic bonds is that it's quite unusual compared to the precedent cat bonds that have been issued in several ways. Okay, so in the prospectus, it specifically stated that the epidemic has to last at least for 12 weeks duration since the first outbreak. And the second restriction is that it has to wait for another 12 weeks since the first official report that would measure the impact of the pandemic. So that means that at least for about 4 months, the countries that are affected by the pandemic are not going to receive any fundings. Why is this unusual? Because if you look at the 2019, the cat bonds that have been issued by World Bank for Philippines government to protect the countries from natural disasters, the amount of the distribution window is only lasting for 1 month, which means within 4 weeks, if the disaster hit the Philippines, the Philippine government is going to receive the money that being distributed by World Bank. So why would the pandemic bonds have to wait so much longer compared to the conventional cat bonds? So that is the question that I'm wondering here. And then which countries should actually receive the benefit from the World Bank? Because now we see that the pandemic is actually spreading all around the world. It's not just on the developing countries. A lot of these donor countries like Germany and Japan are also heavily hit by pandemic. And a more serious thing linked back to the early statement made by Ben is that the diversification benefits usually are seen in the cat bonds are not seen here in the pandemic bonds, because we see that it is getting more and more highly correlated with all the global financial markets. So the hedging benefits, diversification benefits are not enjoyed in the issuance of the pandemic bonds. And lastly, I have this bigger question, and also to pose to the other panelists as well as the audience, is to ask, what is the role of financial market or financial innovation for household? Okay, so traditionally, we all know households supply fundings to the corporates to invest and generate for economic growth in the normal conditions. But in the pandemic bond situation, you can see that the role is reversed. It's actually, it is designed for the financial market to bear the risk of the general public welfare losses. The investor will suffer the capital losses when unfortunate events hit everyone, especially in the developing countries where the funds are most needed. So the essence is supposed to be that when the public is suffering, financial market now can actually provide the support to them. Unlike the traditional financial market's role, right, is the household's money flow to the corporates. But here, the investors can actually, flow the capital to the affected public. Okay, so even the bond is designed this way, but does the public benefit from it? The question is very, very big. Why? Because the more risky bonds are most likely to be triggered, and that is only in the total amount of $95 million. Okay, how about the less risky tranche? Actually, the investor for the less risky tranche will only lose up to 16.67% of their capital, which means it's only 37.5 million out of 225 million is going to be distributed to the affected countries. And the public are very angry about the restriction that have been posted by the pandemic bonds. And they are also blaming that World Bank has been so slow in responding in distribution. And until now, World Bank has not made any official announcement about the trigger of these pandemic bonds. But as a saving, method that the World Bank is taking on, they made a recent public announcement that they are going to put aside $14 billion to help, various sectors of these countries that are affected by the pandemic. So this gives us the understanding. Even World Bank themselves feel that they have not done enough through this kind of financial innovation. So there are a lot of lessons that we can learn about the right role to be played by financial markets in terms of the big disasters like this.
Thank you, Wayna. I think very good. This is a very specific case. We're talking about general ways in which households can be protected. I will just say one thing. I understand that the contractual arrangements have to be improved. The payment scheme has to be improved. All that, the nuts and bolts of the term sheet have to be improved. But the way I was thinking about it was more not the investors, not the household buying the bonds, but rather it continues to be bought by institutions like pensions, the deep-pocketed ones, the Berkshire Hathaways and so on. They continue buying it. And the money that goes out to governments, assuming they can get it all figured out who gets what, when a pandemic happens, the government would enter into a contract with a third party or counterparty financial institution in the country through a total return swap or something, to ensure that their money goes into the household pockets during the pandemic. That's the way I was thinking about it. Not so much as the households going and buying these high yield bonds. So I wonder if there are structures like that can be created. Total return swaps within the country receiving the pandemic aid that can be passed on to the households by some mechanism. But we'll come back to that discussion later. Thank you very much, Wayna. This is a very interesting topic, and I think it also highlights the importance of designing instruments and innovations properly so that it yields a proper result as opposed to be sell-side driven. I think that highlights that very important point. I would like to go to Johan quickly, and I don't want to go through financial markets. I'll talk about what your expertise is. You run one of the most successful graduate programs at NUS Business School. How has technology and innovations helped your program and your teaching pedagogy and stuff like that? Because I know now more and more governments are asking for continued learning, continuing education and all that stuff. So that's also the household. how can they benefit from technology and all these other stuff? If you could talk about that a little bit, Johan, if you don't mind, and please unmute yourself. Thank you. Johan?
Right.
Yep.
So let me just give a quick background in terms of how I see the crisis evolving. I think this particular crisis has hurt the growth momentum of the world's economy. One particular aspect of this is that the financial innovation, financial technology, as well as innovation in the financial market has been squeezed out to some extent by the crisis, and it will continue to be squeezed out, I think, in the near future because of the interventions that the government has to do in the face of this pandemic. So this type of, it could be intervention in the credit market, it could be protectionism, as Ben mentioned earlier, but I think it could also be that the market is just not a friendly one for financial innovation. So for example, I think robo-advisors are having trouble coping with the markets, with the asset correlations going haywire in the market. Robo-advisors are struggling to keep up. I mean, clearly, even experienced professionals in the market will also struggle with this particular situation, but robo-advisors are clearly struggling. So crisis is hurting the growth momentum. But I think we can also use this crisis as a jumping off point to develop and incorporate more efficient technology. And this is the example that you brought up, which is the thinking about the forced technological integration into our pedagogy, into how we teach, how we learn. So clearly there are many things that we can do. We can do better. So during this time of crisis, I think at the NUS Business School, as well as the NUS overall and Singapore, we have learned a lot about technology. I think we have been using a lot of technology during this time. This is forced upon us to some extent because of the public health crisis, but I think it will help prepare us for the future. Right now, there's just a lot of growing pains, right? We're still trying to figure out what works, what doesn't work, what needs to be improved, what can be improved, what is actually in the feasible set that we can do. So, for example, I think one difficulty that we have is that the contents are being delivered remotely, but the students are not learning as well because they don't have the same kind of interactions, both among themselves as well as with the instructor. That's something that we need to do better at. There has to be a better way to do this, and we are still learning on how to do it. I think in the future, what we will see is that we will develop better technologies for learning. For example, we can develop more effective combination of online and offline delivery, so we can maximize the value of offline delivery, meaning the face-to-face, person-to-person interaction. I think that's a crucial part of learning, and I think we need to maximize the benefit of that. It cannot be just a lecture hall where we just talk to 300 students. We need to do better than that. When we have the chance, when we have the precious opportunity to have face-to-face interaction, which clearly is being curtailed right now. And I think schools around the world, including in NUS, are trying to figure out how to do that better, right? Offline delivery is a luxury. We have to think about it that way. It is a luxury, and therefore we have to optimize, we have to maximize that, the value of that whenever we have a chance to do that. Okay, we have to think a lot about what really works offline, and we need to focus on that. Now, the other thing that will happen in the future, I think, is that because online delivery seems to work for some parts of learning, then I think there will be more and more online delivery of modules, of contents, of materials, of learning. And this will end up potentially having an effect of reducing the cost of access, reducing the barrier to entry for those who want to learn. And I think that if this is a good way to democratize learning. Of course, this is forced upon us at this point, but at the same time, we also still need to develop a strategy to optimize the combination between online and offline delivery. Offline delivery is, again, I think is still the best way to learn, but we need to hone on that. We need to be able to optimize the online and offline combination. So again, in some, I think we have lost a lot of momentum in terms of fundamental growth because of the crisis. We have to develop more efficient technologies. We have to use more efficient technologies in the future as a response to this crisis. Now, my overarching concern is that the transition period will be costly, it will be long, and we will have to minimize that. We will have to work hard on trying to do better with the technology.
All right. Thank you, Johan. Thank you very much. I think it's very important you raise this, getting the balance right between offline and online, that you need both. And if we can get this right in the classroom, I think we can also share that experience in the continuing education space for the people out there who are not part of the university, who'd like to continue their educations and so on. So all these learnings will be very useful. So thanks very much for sharing that. And it's a work in progress, I understand. Let me ask Sumit to talk a very important issue about this divide. You've written so much and prolifically on this whole issue of divide, about leaving people behind, and how policies can help people get back on track and participate in the economic development and growth, about jobs over cash, about redistributed policies and so on. Could you please talk a little bit about that and how that impacts the household, especially around Asia and India too included, please?
Let me start out by saying that I think whenever we think about households, we are thinking in this crisis or any crisis, how can we help them? But anytime we help, there is a responsibility of households. And in this crisis, I feel the younger households are not doing their part. Look at any country. They are just going out. The younger kids are saying, look, this virus is not going to affect me. So let me go out drinking and let me go out partying. But they don't realize that has impact on the whole society. So while we are giving them money, we know corporates in Singapore are giving, saying, okay, don't pay your mortgage, don't pay your, any auto payment. The government is doing so much. Everybody is doing their full share, but the households, I feel, especially the younger households or the young people, are not doing the share. Now, this comes back to your point. What do we care about right now? Look, we know this crisis is going to disproportionately hurt the older people. And these are the people who are just retiring or about to retire. They have all their money in the stock market, where they have seen huge losses in their portfolios. They have seen losses of their housing portfolio, which means their assets is going down. So they're losing essentially money everywhere. They're also the most threatened to lose their job, because essentially they are at the top of the ladder earning the most money. So companies are saying, I can hire somebody younger, much cheaper, and I'm going to let you go. So they are the most vulnerable population right now in all sectors, in their investments, in their housing portfolio, and in their labor market. And I think we need to think more about the redistribution of the wealth in some way that we can kind of protect them. I mean, we have redistributed from the rich to the poor a lot. I mean, this is what taxation does a lot of the time. But what we have not done effectively or thought through is how do we need to take care of the older population? The younger people have to play a role. As I said, I think that is where I feel there is a miss. I mean, we are not putting the feet to the fire for the younger people that, look, if you behave like this, we are not going to give you free coronavirus treatment in the hospitals. We will make you pay for it. Let me stop here and I'll answer more questions in the Q&A.
No, that's very interesting. You brought up two issues, that there are some segments of the society that are not playing their role. In fact, I remember how Singapore had to clamp down, and in other countries too. I think Italy did that as well, closing down bars and clubs and so on, because there's just too many people crowding into those spaces and creating a problem. And then the other aspect is, we always talk about the poor, the divide, the social divide, the B40s and the L40s and so on. But we tend to forget there's a big segment called the elderly, and they can be middle income, but they may be struggling as well as they move into retirement with huge losses to their real estate values, to their financial market portfolios and so on. So that's very important, and we'll come back to that. We'd like to open it up for discussion. And so if I could ask the audience to raise their hand electronically if you'd like to ask a question, or if there are no questions, we can just open it up to everyone in this room, including the panelists, if they want to ask each other any questions. If not, I will.
Could I jump in?
Sure. Ben, is that you?
Yes, yeah.
Go ahead.
So I think the ideas brought up by Weina and Sumit are related. And one of the key questions that I wrote down while Weina was sharing her piece with the pandemic bonds was this question of who bears the risk. And in a situation like this, as Sumit rightly pointed out, it's the older generation who's bearing much more of the health risk. And in fact, the young are not factoring in the negative externality that they're imposing on the market, right? And so I'm just thinking that we ask ourselves, the role of financial markets overall is to allocate risk to the people who are most deserving or who are most suited to bear them, right? And related to this, we might think that the young and highly educated, high human capital, people who can work from home, right? These people have the capacity to bear these types of risk. And so, in fact, I might think that in the financial markets, the way it is, there might not be enough financial innovation to get the risk exposure to those people.
Interesting. Is that your point, Ben?
Yeah, so that's
yeah.
I think those two things are related. I mean, I can't speak for all millennials. I try to stay home now, but I do. My question, I guess, is there much scope for trying to come up with ways in which these types of exposures that are unevenly distributed across the population to go into the hands of those most suited to bearing that risk?
So you're saying, Ben, that in addition to the hedge funds, the pension plans, and other institutions with deep pockets who can bear that risk,
Right.
You're saying that we can also look at those who have low correlation to these kinds of things, who can continue working and continue to participate in the economy, could also potentially be offered the opportunity to participate as investors, not as hedgers.
That's right.
So in the sense that they could also perhaps buy these pandemic bonds.
That's right.
And contribute.
Yeah. And okay, so that's an interesting point. I didn't think of it from that perspective, but that's a very good point. Do I see? Yeah, Weina, would you like to say something about that?
Yes,
go ahead.
I would like to respond to Ben's question, and it's also related to what Johan has said, because recently I covered the case about the robo-advisory in my investment class. So what I think about the huge demand going forward is going to be the younger generation who will be more interested to try out this kind of financial technology in their personal investment. So if we have some way to design this kind of financial innovations such that it can be included in the robo-advisory kind of investment vehicles, I think that could immediately have a greater reach out to the younger generations who would probably be more open-minded to robo-advisory, because based on what we have seen around the world, that the majority part of the participants in the robo-advisory is actually the young people.
Very good. Bernard, did I see your hand? Or is it Johan? Somebody's hand went
Johan.
up. Oh, Johan, go ahead, Johan.
Yeah, so I would like to build up on this idea of financial innovations potentially benefiting certain segments of the population more. I personally think that in the short run, these financial innovations will be on the back burner. There's a lot of government interventions at the moment. A lot of these are credit moratorium, bank guarantees, tax breaks, loan restructuring, business guarantees, all kinds of intervention in the credit market, which I think will squeeze the financial innovations at the moment. Now, going forward, I think we will have to consider carefully who should benefit more from these type of financial innovations. We are talking about the younger people potentially benefiting more from the financial intervention, but sorry, for the financial innovation. But I think, like Sumit pointed out earlier, what we should be worried about is probably the older generation that needs to participate more in this type of financial innovations so that they can hedge themselves a little bit better. Because right now we are looking at a large generation that's about to go into retirement, and for many of them, they have under allocated to their retirement, and this is true not only in Singapore but also globally. These are the people, in my mind, that will require some help to get to retirement safely. The younger generation have more time. they have better knowledge of the technology. So I think they can, they have the time to learn more and save themselves. The older generation at the moment, I think, struggling more with this transition.
Okay, Johan, thanks. We have a couple of questions. I think I get your point, but also at the same time, be careful. There's a suitability test. We have to ensure that someone like an elderly person or someone going into retirement doesn't end up investing in a pandemic bond in its current form and find out when they need the money the most that they are coughing up money to the World Bank to cover the cost of the pandemic, something like that. So the suitability point is also very important that it's structured correctly.
Let me add, I think a lot of the financial innovations that have been created so far are geared towards younger people. So think about robo-advisors. Robo-advisors are useful for young people. For old people, they shouldn't be using robo-advisors. It's a clear what it is that they should do. You don't need a robo-advisor to tell them what they should do, but yet people are not doing it. So I think we need financial innovations to help them do that.
Okay, got you. So now I see questions on the floor. If you don't mind, can I just take the question, Bernard, if you don't hold your thought? Tianyu, you have a question. Could you please unmute yourself and ask your question?
Okay, thank you for this opportunity. Actually, I want to just provide some of my input for the issue that the uneven burden of health risk among the young and old people.
Mm-hmm.
So I think that public communication, government-led communication can really help. For instance, in China, in China, I don't think that young people in China, they were educated from very early on by the government that this was a serious outbreak and there was no flooding of bars or clubs by young people in China. So I think that early on, Chinese government, central government, local government have, launched a full communication, or some people call it propaganda campaign to educate people to stay at home and obey the rules. In some other countries, particularly in the United States, the leaders are saying that elder people and people with underlying medical conditions are more vulnerable to the virus. So I think that these piece of information actually kind of induce some people, especially young people, to ignore the risk. So I mean, at this point in time, a lot of resources are being spent. So I think that communication might be a cost-effective way to basically achieve, safe distancing and other measures that can help curb the health risk for the society.
Okay, thank you, Tianyu. I also see another hand from Jin Chuan. Would you like to speak, Jin?
Okay. Yeah. Okay. I have one comment and one question for Ben. Actually, the comment is, being in a fine city in Singapore, we know that expecting people to behave in some way is sometimes too much to hope for, and so we had to sort of have a system. So in terms of intergenerational sharing, and the earlier comment about unfair distribution, the older people are bearing the brunt of this. It's much better to actually go back. We maybe have to rethink going back to define benefit kind of insurance, a pension scheme, because younger people, they were, in this case, they will bear the burden of old people because they have lost their wealth so much, right? So I think it's actually time to think about it. The movement to define contribution, it may not be a very good society safety net kind of design. Okay, that's my comment. The question I have for Ben is, he mentioned about the equity premium, risk premium gone up a lot. That, of course, we all sort of think instinctively, conceptually, that had to be the case. Is there evidence of that, and how much of it? Because if you do estimation, and you're not going to see it, right? Because ex post return is going to be negative. How is supposed to get risk premium? So I'm wondering, where was that, any sort of evidence number to come up for us to refer to?
Good question, Jin. So there were new research done, for example, by Ian Martin in Econometrica, the paper called "What is the Equity Risk Premium?" and they estimate that from the options markets. So options markets are forward-looking, And so we can pull expected returns directly from stock index options, or alternatively, you can look at simultaneously the dividend futures information. So the numbers I quoted with the decrease, lower bound decrease of 40% for the US for the next 2 years, that comes from dividend futures. You can make some assumptions to combine the futures information with the equity, with the stock index information. And we could see that the stock markets are currently pricing the stock index level as if there's going to be effectively no dividends for the next 10 years. So we know that's likely not true. In the dividend futures markets, it shows that's not true. So then it has to be equity risk has gone up. So I mean, quantitatively, we can estimate this. And I agree that from a policy making perspective, that itself might be interesting. I think the equity risk premium is important because in terms of who's going to end up bearing the risk, and related to Sumit's point that people who are retiring around this time actually are seeing tremendous negative impact on their portfolios. Well, if we get enough more new money to get into the market, that is actually going to be alleviated also. There's some research coming from India that shows that stock market participation contributes to inequality. There's a lot of discussion about robots replacing people all around the world. And so one way to democratize and improve on this inequality is to get more people participating, I think, in the future economic growth. I mean, it seems like the world will get out of this one way or another, and the question is how long. But the longer term impact, I think, is we should focus on the role of these financial advisors, or how do people enter the market in the first place. The robo-advisors that Wei-Na and Johan were talking about all came out of after the financial crisis. It was because younger people who experienced the financial crisis lost faith in the financial system and in their financial advisors. And so let's set up machines to do it instead, right? So I think something similar like that might happen. Unfortunately, locally in Singapore, just last week, March 25th, one of the robo-advisors here in Singapore shut down. Mm-hmm. But that said, before that, there was huge growth, and the Monetary Authority of Singapore, I think, has already taken a lead in the ASEAN region to set up a regulatory sandbox to allow some of this financial innovation. So, you know, in light of the darkness, I think there's still a glimmer of light that, you know, young, well-educated people might also help to solve the problem if they can just stay outside of the bars.
Okay, thank you, Ben. We are running a bit over time, but if everyone's okay, we'll just keep going for a few more minutes. I'd like to just ask if anyone, I don't see any questions, but if Sumit or Wei-Na or Wen-Lan would like to add any thoughts to the discussion we just had. We know financial markets are very complex. It takes a lot of effort, skill, and a functional type of thinking to provide the right products, suitable products for different segments of society. Now we know we might be missing out the elderly in this. It's not just buying bonds, but buying the right products. But anyway, would Wei-Na, Wen-Lan, Sumit have any thoughts to add to this last part of the discussion?
Let me add a couple of things. One, I think I agree with Jinduan quite a lot that I think we'll have to think about moving away from defined benefits to defined contributions, where people will be, the elderly will then be protected in their retirement time if some kind of shocks like this happen. Also, we'll have to think more broadly. I mean, from the past crisis, we realized, look, people lost faith in the intermediation industry. That could be across the domain, like financial intermediaries, robo-advisors came in, mortgage brokers and real estate agents also played a big role in that crisis. In this crisis, what are the factors that will create loss of faith in the financial markets, and how do we come up with innovations in those domains to protect either the elderly or the young people or whoever, either in the stock market or in generally dealing with banks. Maybe deleveraging is one solution for that. If you're not leveraged enough, you don't have to worry about these kind of pandemics or any other financial shocks.
Thank you, Sumit. Those are good points. I think you said you agreed with Jim that you got to move away from the defined contribution format to a defined benefit. Or the other options, like what Singapore does, it's a hybrid, where basically you have a defined contribution plan, but a large chunk of the accumulated savings can be put into a CPF Live program guaranteed by the government to a live stream of payouts, which is like a defined benefit program. So a hybrid system may also work. And again, Singapore and a few other countries do that. That's one way to go around that. The other one's a loss of faith in financial intermediation. This always happens after a crisis. And sometimes we shoot ourselves in the foot because we put other priorities over and above our fiduciary responsibility. And I think we need to go back to basics about what's our function, about serving the client and intermediating for the benefit of our clients and so on. And then you do well when you do good, kind of thing. That always happens. So thanks, Sumit, for those good parting points. Are there any other comments from panelists? Oh, I see a hand go up. Wena, would you like to say something? Please, Wena.
Yeah, I would just like to add on to the early discussion Sumi brought up in the very beginning session about social capital, because I think that this is something that we should also pay attention to in the midst of this pandemic, because in some countries, when the government are making the swift response, they are building the social capital in preparation of the future, crisis. And when you talked about, the even distribution across different individuals and households is another way to build up the social capital. And then we also mentioned about all this financial crisis, which actually reduce the trust from the investor to the financial market. So I think the question that we should also think about is how we would be able to build the social capital in the financial markets itself as well in this kind of situation.
Very good, thank you. I would like to say that we have actually run over time, and unless there's any burning question or any panelists, or Bernard, is there anything you wanted to say? I saw your hand go up earlier, but are you good? Okay, very good. So I would like to just wrap this up by saying that financial markets are very,
please interrupt. There's something in my mind, which is behavioral. I'm thinking about what Sumit said about the young people not paying attention, and what Tianyuan said about communication, and also linking about like Duan Jingquan said about the design. All in all, there is a behavioral aspect in this. We're thinking about how rational people and how rational product designers and how rational product subscribers are engaging in transactions. But at the same time, there is really a behavioral aspect in this. I feel that very often, unless the fire is in my backyard, I don't pay attention to it. And maybe that explains why the West, for so many months, are not paying attention to what's happening, and why the young people, they just don't think that they will die. So there is a behavioral aspect in this that maybe we need to use this opportunity to drill a bit further down to understand more.
Yeah, and I think that's a role we can play in closing. I'd say educators, finance researchers, finance academics can play a big role here. There's the importance of technology, the importance of investment science, the functional approach to designing securities, at the same time understanding behavioral finance when you implement such policies. I think this is all very important. I think that gives us a very important role to step up to the plate and come up with ideas and solutions and strategies that help households, ordinary people, the ones who are normally left behind, elderly, how they can improve themselves and come out of these things better. That's the aspect of retirement finance as well. There's so much we can impart from our research and our unlearnings about how to improve retirement schemes around the world. I also see that many countries are digging into their retirement pot at this time. When markets are down, when their investments are down, they're also allowing households to dig into their retirement pot before retirement. And I think that's also a bit dangerous. So a lot of issues that we can do through the education process. It's a very complex matter when you talk about financial markets and its interaction with the economy and society. But I think that means we have to step up to the plate. And there's lots of more research that ABFAR can do, and the finance department and business school can do as a result. With that, and with your permission, Bernard, unless you want to say something in closure, I would just say no, nothing. Okay. So on behalf of Bernard Sumit of the Finance Department, Bernard of ABFER, I'd like to thank all of you for sticking through the day, sticking out for this program, and for your questions and participation. With that, as Bernard mentioned, there will be videos of this available on the website at the Business School and ABFR website, perhaps even commentaries, and we hope to use some of this in our teaching and classroom process. With that, let me thank everyone for joining, and have a good rest of the day. Stay safe and healthy.
I think we also should thank Joe. He has put in a lot of hours helping and guiding our conversation in the past almost 4 hours. I want to thank Sumit. I want to thank everybody. And I would love to hear your comments on how we can make this better and how we may be able to use the material for engaging our stakeholders, to inform them, and also to conduct collective learning. Thank you very much to everybody. And the team, thank you. The Mean team has done a wonderful job. Thanks.
Bye-bye, everyone.
Thank you, everybody.